Hello, investors. April was a primarily positive month across global indices, with the largest gains coming from the UK and Europe. This coming off the relative lows from the March sell-off due to the banking turmoil. A lot of the volatility caused by the banking sector subsided in April, but not without repercussions. Silicon Valley Bank, which was once the 16th largest bank in the US, collapsed almost overnight, and Credit Suisse, once the second largest bank in Switzerland, had to be bailed out by UBS, the largest Swiss bank. In both cases, regulators had to step in to arrange special deals with public markets. A lot of the volatility caused by the banking sector subsided in April, but not without repercussions. Silicon Valley Bank, which was once the 16th largest bank in the US, collapsed almost overnight, and Credit Suisse, the second largest bank in Switzerland, had to be bailed out by UBS, the first largest bank in Switzerland. In both cases, regulators had to step in to arrange special deals with public markets. Fears of the broader banking sector fragility still exist, particularly in the US, with concerns around credit tightening and stricter lending criteria growing. The US Federal Reserve and European Central Bank raised rates once again at the start of May, marking the fastest and most aggressive rate hikes in history. This is another area of concern for us, which we will delve further into in our outlook. The earnings season for Q1 also kicked off at the end of April. What is clear is that there's a growing bifurcation between smaller companies who are struggling to pay the interest on their capital structure and larger companies, particularly tech, who did better than expected, albeit with lower revenue than this time last year. A common theme amongst companies that did do well is a paring back or of expanding or entering into new projects. Apple, Google, and Meta all reiterated their share buyback program as a means to inflate their share prices. In the UK, the Bank of England delayed its Monetary Policy Committee meeting due to the King's coronation till this week, Thursday, on May 11th. They're expected to follow suit with the US Federal Reserve and the European Central Bank by raising interest rates another 0.25%. All central banks confirmed progress on their quantitative tightening program designed to decrease money supply in the economy as part of its fight against inflation. A key theme to our thinking is that we think that financial markets have become somewhat used to and immune to these expected base rate rises. The narrative is now changing to the negative effects these sustained high interest rates are having on the economy in areas such as unemployment, trade, and the banking system, of course. In the UK, the Consumer Prices Index, CPI, rose to 10.1% in the 12 months to March 2023, down from 10.4% in February. In the US, CPI was 5%, down from 6% the previous month, and in Europe, the CPI number was slightly higher at 7%. Central banks have continually said that their aim is to keep interest rates high until core inflation subsides back to their long-term average of 2% per annum. Our previous economic and market projections remain unchanged, with an anticipated significant downturn in equity markets across major geographic indices such as the US and Europe, albeit at different stages. As aforementioned, we think prolonged high interest rates are going to cause instability in global economies, particularly in the financial sector. A credit crunch, which means the availability of lending is scarcer, is a real possibility as banks tighten their lending standards. Small businesses, which rely heavily on bank financing, are particularly vulnerable to limited resources being available to sustain their existence. This tightening of credit could lead to decreased capital expenditure and slower payroll growth in the future, ultimately leading to increased unemployment. There is also still lingering uncertainty as to whether the most recent quarter-point hike will be the central bank's last, or whether they will continue to raise rates and put further pressure on businesses. We did not make any changes to our asset allocation in April, but in March, we moved away from our India and market neutral holdings. The proceeds from these disinvestments were used to purchase an index tracker for emerging markets to our benchmark weighting. We believe we purchased this at a relative low point. We're still closely observing all of our other equity index prices, particularly North America, UK, and Europe, and anticipate reinvesting at benchmark levels when we feel they have reached relative attractive re-entry points, considering the expected market downturns ahead. As always, we encourage you to contact your financial advisor should you have any immediate concerns. If you have any further questions for us, we of course welcome them and ask our clients to contact us on the email on the bottom of your screen. Thank you.